Welcome to UXL, where you can learn new skills anytime and anywhere. Visit uxl.com to explore our full course selection. This lesson is part of a larger course. Check the video description below for a link to the full course where you can enroll. If you enjoy our content, please like and subscribe. For your convenience, the course cover displayed on your screen provides the complete course title and lesson title. Let's proceed with the lesson. Lesson: What is monetary policy? Central banks, such as the Federal Reserve in the United States, the European Central Bank, and the Bank of England, are tasked with the formulation and execution of monetary policy. These institutions utilize a range of tools to influence the economy, with the primary instruments being open market operations, the discount rate, and reserve requirements. Through open market operations, central banks buy or sell government securities in the open market to adjust the level of bank reserves and influence the overall money supply. Adjusting the discount rate, which is the interest rate charged to commercial banks for borrowing funds, directly impacts the cost of borrowing and lending in the wider economy. Reserve requirements dictate the proportion of deposits that banks must hold in reserve, affecting the amount of money available for lending. One of the principal goals of monetary policy is to control inflation. Inflation, the rate at which the general level of prices for goods and services rises, erodes purchasing power and can create economic instability. By managing the money supply and influencing interest rates, central banks aim to keep inflation within a target range. Empirical evidence suggests that moderate and stable inflation contributes to economic growth by providing a predictable environment for businesses and consumers to make long-term financial decisions. For instance, during the early 1980s, the Federal Reserve, under Chairman Paul Volcker, implemented a series of aggressive interest rate hikes to combat the high inflation that plagued the U.S. economy. These measures, though initially painful, succeeded in bringing inflation under control and restoring economic stability. Monetary policy also plays a crucial role in managing economic cycles. During periods of economic downturns, central banks may adopt expansionary monetary policy to stimulate growth. This typically involves lowering interest rates, which reduces the cost of borrowing and encourages both consumer spending and business investment. An example of this can be seen in the response to the 2008 financial crisis. Central banks around the world, including the Federal Reserve, slashed interest rates to near zero and engaged in large-scale asset purchases, known as quantitative easing, to inject liquidity into the financial system and support economic recovery. Conversely, in times of economic overheating, when rapid growth leads to inflationary pressures, central banks may implement contractionary monetary policy by raising interest rates and reducing the money supply. The effectiveness of monetary policy, however, is influenced by various factors, including the transmission mechanism and the expectations of economic agents. The transmission mechanism refers to the process through which changes in the central bank's policy instruments affect the broader economy. This involves several channels, such as the interest rate channel, the credit channel, and the exchange rate channel. For example, when a central bank lowers interest rates, it not only reduces the cost of borrowing, but also affects asset prices and exchange rates, which in turn influence consumption and investment decisions. Moreover, the expectations of businesses and consumers regarding future economic conditions play a significant role in the effectiveness of monetary policy. If economic agents believe that inflation will remain low and stable, they are more likely to engage in economic activities that support growth. One of the challenges faced by central banks is the time lag associated with the implementation and impact of monetary policy. Changes in monetary policy do not instantaneously affect the economy. There is often a delay before the full effects are felt. This lag can complicate the task of central banks as they must anticipate future economic conditions and adjust their policies accordingly. Additionally, the globalized nature of modern economies means that monetary policy actions in one country can have spillover effects on others. For instance, the Federal Reserve's policies can influence global financial markets and capital flows, affecting exchange rates and economic conditions in other countries. In the context of the current global economic environment, the role of monetary policy has evolved to address new challenges. The prolonged period of low interest rates and the massive expansion of central bank balance sheets, particularly following the 2008 financial crisis, have raised questions about the long-term sustainability and potential side effects of such policies. Issues such as financial market distortions, asset bubbles, and the limitations of traditional monetary policy tools in a low-interest rate environment have become areas of concern and active research. Furthermore, the COVID-19 pandemic has prompted unprecedented monetary policy responses, with central banks once again employing a range of conventional and unconventional measures to support economies and mitigate the economic fallout. In conclusion, monetary policy is a fundamental aspect of economic management that central banks use to influence macroeconomic conditions. Through instruments such as open market operations, the discount rate, and reserve requirements, central banks aim to control inflation, manage economic cycles, and promote stable economic growth. The effectiveness of monetary policy depends on the transmission mechanism and the expectations of economic agents, with the time lag and global interconnectedness posing additional challenges. As the global economic landscape continues to evolve, central banks must adapt their strategies to address emerging issues and ensure the continued stability and growth of the economies they oversee. This concludes the lesson. We trust you found this video informative and engaging. To enroll in the complete course, please use the link provided in the description below. At UExcel, we are committed to your learning journey. Each course offers a certificate of completion, online support, and downloadable resource files to enhance your experience. If you found our content valuable, we invite you to like this video and subscribe to our channel. Thank you for joining us, and we look forward to supporting your continued pursuit of knowledge.